Welcome to the Compliance Officer's Playbook podcast. Financial crime is not a static beast. It is constantly evolving, perpetually seeking out new, high-volume, and complex routes to clean, dirty money. Today, we are charting the current battlefield of illicit finance by examining two contrasting frontiers. On one side, we have the persistent foundational challenge of money laundering through the markets, MLTM, which leverages the high speed and scale of capital markets to exploit regulatory blind spots. On the other, we are examining the revolutionary technological response, the implementation of agentic AI, which is fundamentally changing how we generate high-quality, suspicious activity reports, transforming what was once a massive human bottleneck into a scalable, precise intelligence tool.
That tension is really the core of what we're looking at today. We're not just talking theory here. We're pulling findings directly from major regulatory reviews. The UK's National Risk Assessment back in 2020 clearly highlighted that capital market stocks, bonds, currencies remain a preferred route for criminals. And it's because of the inherent complexity of global transactions.
And we're seeing regulators act on that, right?
Absolutely. We've seen the Financial Conduct Authority, the FCA, recently complete a major thematic review specifically targeting MLTM risks in wholesale broking. We're contrasting that regulatory expectation with the hard data coming out of the NCA and the ICAEW regarding the persistent quality issues and, frankly, the sheer volume of SARs being submitted. And then we pivot to the cutting-edge research detailing how these multi-agent AI systems are successfully tackling this exact compliance problem.
So our goal for you, whether you're a compliance professional prepping for a regulatory visit, an investigator battling alerts, or just someone intensely curious about the sharp end of financial risk, is really clear. This discussion is designed to provide you with a comprehensive understanding of both the current threat landscape and the necessary control frameworks. We need to balance the critical importance of robust, foundational compliance with the urgent need for technological solutions designed to drastically reduce investigator burden and, most critically, enhance the accuracy and utility of the intelligence shared with law enforcement. Okay, let's unpack this with the core threat, MLTM. The concept itself seems pretty straightforward, but the execution is incredibly complex. How exactly do we define it, and why are capital markets in particular such a magnet for criminals compared to, say, traditional banking?
At its simplest, MLTM is using the trading of financial instruments, be they stocks, derivatives, foreign exchange, or bonds to layer and integrate criminally generated cash. The goal is to make it appear legitimately generated from successful investment activity.
And the appeal is the environment itself.
The appeal of the markets for launderers is systemic. I mean, think about the speed alone. Money can move across continents in milliseconds, often via complex, multi-jurisdictional transaction chains that intentionally obscure visibility.
Right, and the volume provides the camouflage.
Exactly. The sheer volume and value of daily trading activity provide perfect camouflage. You also have the accessibility of complex financial products, coupled with the inherent anonymity afforded by many trading structures. It just creates the ideal environment for sophisticated criminal networks to exploit at scale.
And the FCA specifically zeroed in on wholesale brokers in their recent review. Why target this specific part of the market? What is their unique vulnerability?
Wholesale brokers are key facilitators. They sit right in the middle of this vast ecosystem. They are typically agency brokers, which means they don't usually trade on their own account, but act as critical intermediaries.
So they're connecting the big players.
They are. They facilitate price discovery and source liquidity for institutional clients, the larger banks, hedge funds, and high net worth individuals. Their role involves significant discretion in bringing transactions together, often across multiple regulatory regimes globally. This central intermediating position means they can have a massive impact on market integrity. And, conversely, they are highly vulnerable to being exploited as a gateway for large-scale MLTM purposes. It's all because of the high-value, fast-paced nature of the flows they manage.
Now, when the FCA looked at their control frameworks, they noted that while there is some good practice, significant improvement is required, particularly in foundational controls. Let's start with Compliance 101, the Business-Wide Risk Assessment, or BWRA. This is where firms define their risk appetite, yet it seems many are missing the mark.
That is a fundamental finding, a really crucial one. The FCA observed that many wholesale broker firms either hadn't fully considered or, even worse, had severely underestimated the specific financial crime risks they actually faced.
Or they end up with generic documents.
That's it. This resulted in BWRAs that were generic boilerplate documents that weren't tailored to their unique business models. For example, they might include risks relevant to retail banking, but completely fail to address the specific vulnerability associated with complex FOP transfers in illiquid bonds, which is a genuine MLTM route.
So the consequence of that is lack of institutional clarity. The
Yeah.
staff on the ground don't know what to look for.
Precisely. The broad definition of risks prevents staff across the firm, not just in compliance, from understanding the specific criminal methods they should be looking out for, and that leads to inadequate resource allocation and ineffective controls.
So what does a good BWRA look like, according to the FCA?
The effective BWRAs the FCA praised used both qualitative and quantitative assessments. They assigned a measurable impact and probability score, say 1 to 5, to specific inherent risk factors: exposure to predicate offenses, geographic operating environment, proliferation finance. They calculate an inherent risk score, multiply it by the perceived strength of their controls, and then derive a residual risk score, which they then check against their predefined risk appetite thresholds.
So it's a measurable, documentable strategy, not just a checklist.
Exactly.
Moving from the firm-wide view to the individual customer level, the Customer Risk Assessment, or CRA, also shows some crucial deficiencies, mainly concerning documentation, it seems.
Yes, the CRA processes are definitely maturing. Firms are increasingly using weighted factors and adopting sophisticated country risk assessment tools that factor in MLTF risks, sanctions exposure, and corruption risks, often sourced from third-party experts.
But the devil's in the details.
It always is. The regulatory pain point is documentation and auditability. Firms frequently failed to document the rationale when they updated or, critically, when they overrode a customer's risk rating.
That override is so important.
It's vital. If a client is initially flagged as high risk due to their jurisdiction and that rating is later downgraded, you need a clear, documented audit trail explaining why that override occurred and who authorized it. Without that, it just looks like you're downgrading risk for commercial reasons.
And speaking of risk ratings, the FCA review specifically highlighted some issues around politically exposed persons, or PE.
This is a nuanced compliance requirement that, a lot of firms are still mishandling. A limited number of firms adequately distinguish between domestic PPs and foreign PPs as required by the money laundering regulations.
What were they doing instead?
Many simply treated all PPs as automatically high risk by default.
And why does that distinction matter so much? I mean, treating everyone as high risk sounds safe, but it's actually inefficient.
Right. It is. The key distinction here is proportionality. Foreign PEPs, particularly those from jurisdictions with poor corruption perceptions, they often carry a higher inherent risk profile, justifying stricter enhanced due diligence, or EDD. By blanket rating domestic PPs as high risk, firms often waste valuable resources applying intensive EDD where lighter, more proportionate controls might suffice. And that diverts attention and budget away from the truly critical risks emanating from complex cross-border structures.
So the risk-based approach demands that granularity, not just a broad brush generalization.
That's it, exactly.
Now, let's get into what you called the catastrophic failures in Know Your Customer, KYC, and Customer Due Diligence, CDD, that cripple monitoring efforts downstream. What were the two most damaging regulatory findings here?
Okay, the first is inappropriate reliance. Firms are assuming that if they deal with a major bank or a regulated exchange, someone else in the chain has already completed the necessary due diligence on the underlying client.
A huge assumption.
A massive one. The FCA is explicit. If you're loving this conversation and want to be part of keeping it going, the best way to support the show is to become a paid subscriber on Apple Podcasts. You'll get access to the full episode, plus every deep dive we do. Head to Apple Podcasts, search Compliance Officer's Playbook, and join our growing community today. Invite listeners who love this show to become a paid subscriber today for $5 USD, and get full access to all premium episodes packed with insights, stories, and value they won't find anywhere else. Thank you for joining us on the Deep Dive.